Bernard, it's very good to have you here. My name is the Finance Ghost. For those who keep logging onto these things in the hope that my camera will be on, I'm afraid I have to disappoint you again. But luckily, we've got Richard, who you've met before, and Andre, who you've met before. And the markets have been so hectic that Andre brought another Andre to help him. So it's Andre squared and Richard this morning, but I'll let each of them introduce themselves accordingly. Thank you for being here. I'm going to hand over to the team now and thoroughly looking forward to what we can learn this morning.
Yeah, good morning. Thanks, Finance Ghost. Everybody, we're just here to just give a little bit of a market update of what's happening in the market out there. So everybody's probably reading the markets and talking about inflation. So we had a national shutdown yesterday about everybody causing about the rising cost of living and interest rate hikes and where we're going. And all of that started at a certain point in time. And Andre Salia will go into some detail and explaining to everybody about why are we in this situation with inflation running wild, why are central banks hiking interest rates, and what's the chances of having us a global recession, and what the impact of that all will be in South Africa. Then on the right-hand side, there's a chat where everybody can leave their questions, and that's why I brought Andre Botha as well. He is quite schooled up as well. He's got a master's degree in economics as well. So he'll also attend to some of the questions of the presentation that we will have. But for now, without further ado, I'm going to hand over to Andre Salia to give us a bit of a market update about what's happening. Thanks, Andre.
Thank you. Good morning. Yes, the heading of the presentation, inflation, rate hikes and recession, looks very similar to the last one that we discussed about. But those are still the key drivers that goes down in the market. So with further ado, let me move on to the first graph. If we look at the main contributor to inflation, then we can see the energy inflation soaring, stoked by the Ukraine war and the Russia natural gas squeeze. Down at the bottom graph, we can see what that does to the European side. And we've just added the French side and the German graphs. And you can see this massive spike coming in since the Ukraine war started. And what that did, and we all know what that did to our own petrol prices and our own diesel prices. So the European side just squeezing a lot more on that because of their dependence on the gas pipeline and the oil from Russia into the European side. And we know that now in the last couple of days, it's been announced that for 3 days, that pipeline will be closed off again for some maintenance work. But the one other factor that also comes in is we've been through a summer in Europe that was an extremely hot summer. And made their dependence a little bit slower, but we are in the end of August, going into September, where we've got the change of seasons, and it changes very quickly in the European side. And as we go into the winter, their dependence on gas and energy out of Russia just increases rapidly. The one thing that a lot of people tend to forget is that a key driver is also the explosion in global central bank stimulus. Now, this goes back to 2008. There's always a lot of young people in the market, and I always say that they sort of tend to forget what happened some 14 years back. About 14 years back, we had the subprime crisis in the United States. We had a big investment bank called Lehman Brothers that went under, and that's where the central banks started pushing into that financial crisis that happened there. They started pushing in money. But if you go to 2020, then you can clearly see that the little bit of money, and I call it a little bit, it jumped from 5 to 15 in the period 2008 to 2020, and then suddenly almost doubled that amount in only a couple of months as the pandemic hit the world called COVID. Now, we all know what the economic textbooks are saying, and Andre can, if you have any questions about that, answer that, the other Andre. But if you start printing cash, then that will lead to inflation eventually. The Federal Reserve, we can see, responded with mega force. If you go and think about the previous graph, you can see how much the central bank in America had done during this COVID period especially. But the bulk of the stimulus, percentage-wise, comes from what happened in the United States. And I'll elaborate a little bit more about what the impacts of that could be. Then if we see and look at the inflation that's been on the rise, we can clearly see that it's not something that's just hitting South Africa with our inflation rate coming out yesterday at 7.8%. It's something that actually hits the high income countries a little bit more. And fortunately for South Africa, for the first time in a heck of a long period, our inflation is actually a little bit lower than what the rest of the world, especially on the high income countries, are. But you can see clearly that this inflation monster is not something that's just hitting one or two countries. It's hitting all the countries throughout the world. Driving interest rates, we know what we have to do when we have inflation and when we see inflation. It's simply the fight that is brought to the table by inflation rising is accepted by interest rates. Federal Reserve, UK, everybody jumps onto the wagon and they have to fight that inflation, because if you do not fight that inflation, it can become a runaway inflation, and that's very, very negative for what happens in your economy and the impact of that on your economy. Interest rates on the rise globally. Once again, you know, we sit here in South Africa and we think, what is it, only us? Well, fortunately, South Africa was on the front end of this, and we started increasing interest rates a little bit before the rest of the world. But we pulled out some countries here so that you can see, and you can see clearly once again, just as inflation is on the rise throughout the world, interest rates is on the rise throughout the world in this fight against inflation. There is one place where the things look a little bit differently, and that's out of China, who's actually cut their interest rates not so long ago. And the reason for that is that the figures coming out of China is not, the economic growth figures is not as rosy as it always was. And China seemed to be sitting with quite a few problems. Now we know that China has also responded to COVID with further lockdowns not so long ago, and that their COVID cases is still looking rather dismal, and they still have a zero COVID policy, contrary to the rest of the world, and that impacts on their economy quite significantly. And hence they've actually embarked, and I've read this morning that they've just come out with another $146 billion stimulus package in trying to prop up the economy, an economy that was severely impacted by what happens in the construction industry and the housing industry. And obviously the central bank and the government, they're responding quite aggressively to that with stimulus, and then also cutting their interest rates. As I say, that stands in a bit of a contrast to the rest of the world that's actually increasing interest rates to fight inflation at this point in time. The best of the recovery is actually, we can see behind us, and we can clearly think why, and that's because interest rates on the rise. When interest rates is on the rise, you take money out of the pocket of the consumer, and the consumer has got less money to go and spend in the economy. They're battling a little bit more. They sit with higher mortgage payments. They sit with higher payments on all their debt, credit card debt and everything. Nothing new to anybody with debt. They know that as these things rise and as fuel prices rise, money is taken out of their pocket, and that's got a direct impact on what happens in the private sector as the activity slips globally, and we can see how that turns downwards, and that eventually will then obviously impact on the growth in the economy, and as there's the looming higher interest rates going either further to fight this inflation, and we just have to think that in the UK, inflation is now rising to above 10% levels. I've read this week that people say that inflation in the UK could even go to 18%, and that impact of that on interest rates will even take more money out of the pockets of people. In the UK, it's now being looked at as, what will you do? Will you pay for your house and your energy, or will you buy food? Which one will rank highest in terms of where you spend your money, simply because there's a lot less to be spent by the private sector. Many more vulnerabilities have emerged. Just another figure or two that we can show you, showing this clearly. You can see that UGI's mortgage applications is falling as interest rates rise, and that's a very clear direct impact on their housing market, their housing starts and everything. That's turning negatively in the US, and that's simply because, as I said in the previous slide, people has got less money, they cannot spend that much, and that hits the economy in bad and negative ways. US economic expectations deteriorating due to the rate hikes, and we can clearly see there on that graph how that turns down as the disposable income of people are just taking a big knock through this whole interest rate hike cycle. Now, speculators remain bullish on the US dollar, but we've got to ask the question whether that dollar strength is justified or unjustified. Now, I've spoken a little bit already on what happens in the United States. We look at their mortgage bonds. We know that their housing starts, their retail sales, all their figures are turning negative. But yet people are remaining, speculators are remaining bullish on the USD. And that's a bit of a concern, because the dollar index there, you can see there the gray line standing, it sort of turned close to the 110 level. At one stage, it did actually go slightly above the 110 level. And that's historically very high levels for the dollar index to be trading at, simply because everybody, as they expect this interest rates in the US to go on the increase, and with a Federal Reserve that's fairly aggressive in their fight against it, with their 75 basis point increases. We've already had 2 of them, possibility of another third one coming in, and that sort of pushes money out of the emerging markets, out of the world into the United States, because for a very long time there was no real interest rates in the United States that made anybody happy. But I've also put it a little bit differently. Because of the big uncertainty in the world, when you look at what happens in the Ukraine, when you look at what happens with interest rates, you look at what happens with world growth, you look at everything that happens, everything makes people very, very nervous. And as it makes them nervous, they buy dollars, because that gives them a bit of a safe haven, and that makes them feel a little bit more comfortable than exposing themselves to other markets. And that's why speculators are remaining bullish. But I think at this point in time, if you look at figures also turning negatively in the United States, like I've shown on their housing starts, etc., then one's got to ask the question, is that justified to still be that bullish on the USD? Because if we're going to speak about a recession that can happen in the European zone, with their dependence on gas and their high inflation and higher interest rates and impact on their economies, is it then true that the United States, even though their employment figures are still looking reasonably well, is it then true that they can really escape what happens in the rest of the world as the rest of the world moves towards recession? Why would the United States be on such a strong foot that they can escape this? And my view is that they cannot escape it. And that in the coming weeks, in the coming months, we will see their figures in their economy showing us more negativity on their economy and putting a little bit of a damper on how fast the Federal Reserve can actually move on their interest rates because of the impact of all the world decline in world economy growth, also on what happens in the United States. So I think that little gray line that we see up at very, very high levels will soon also show some weakness, and we will see a bit of a decline in what happens on the US dollar. What will be the impact on South Africa? Now, I want to turn this a little bit back to South Africa because that's where we live, that's where we earn, that's where we spend our money. That's the currency that we operate in, and that's what we really want to know, what happens with us. So commodity prices is retreating. I've mentioned a world economy that comes under pressure. I've mentioned the possibility of recession throughout the world in a lot of countries, especially Europe, and the impact of that on what happens in the US. I've spoken about China that's not doing that well, and all of these things really looking negative for commodity prices, because if the world economy takes a bit of a knock, then commodity prices has already showed us that retreat because of the demand that could be lower for commodities. And as interest rates rise, the price of gold also comes a little bit under pressure, because it's better to put your money into dollars than into a safe haven of gold. Inflation is still high. We've had the figure in South Africa yesterday, 7.8%, so a little bit higher than the previous figure of 7.4. But we must remember that that figure that came out yesterday is the inflation figure that still brings in the for the month of July. Now, in the month of July, then you have the energy prices that goes up. Those announcements of how much Eskom is going to take more and how rates and taxes and so forth by city councils and electricity prices from city councils through to the consumer gets announced already in April, but it only takes effect in July. So that increase is clearly showed in the inflation figure that came and was released yesterday. And we also still had the increase in the fuel price that was quite a steep one in the beginning of July. Now, in August, we've already had a decline in our fuel price. We will not have higher energy prices into the August figure. And it seems that the inflation on food will also sort of top out a little bit. Obviously, the impact of lower fuel prices will have an impact on that as well. So the August figure will most probably come in a little bit lower, and then with a fuel price that could decline again by some 2 rand in terms of petrol, and in terms of diesel in the order of a 1.40 rand, 1.45 rand for diesel by the end of this month, beginning of September. Once again, the September one could also come in a little bit lower, and I would not be surprised to see our inflation rate towards the back end of the year, beginning of the first quarter next year, to be coming back closer to the top range of the inflation band of 6%. So some positive news. We will most probably see a South African Reserve Bank fuel prices, as I just sort of just go on to this, fuel inflation, keep the South African Reserve Bank cautious. But I think with oil prices, with what happens in terms of the exchange rate and so forth, going into the back end of the year, we could see a South African Reserve Bank that moderates a little bit on the increases of the repo rate. Now, I think at the next MPC meeting coming in for September, we will most probably see another fairly steep increase rate by the South African Reserve Bank, a minimum of 50 basis points, most likely 75 basis points. That would be to stay ahead of the curve as other central banks throughout the world are increasing their interest rates. But I think thereafter it will moderate. Now, if we look at this graph, then the professional market and how professional they are becomes debatable, but I will not comment on that. But they have lowered since the middle of July to the middle of August. They have lowered their expectations of how high the repo rate will go and increases will go by the central bank. So I'm in line with that. Not that I call myself professional, but I'm in line with that. And I think most probably 50 basis points and then maybe another 25 basis points. And then that would be it. And that would be sort of the top of the curve of where we will see the South African Reserve Bank taking our interest rates to. Repo rising, but I've spoken about this. I think that it will top out soon. I'm not the only one throughout. As I said, the whole professional market is on the same path as what I'm thinking. The rand is still undervalued. Now, if we look at the graph on the left-hand side, that's plotting the rand versus the dollar on a real exchange rate basis. Now, we can see it well below the zero line, the zero line being the par value for the rand to be not over or undervalued, but just be on par of where it should be. Clearly undervalued substantially against the dollar. But if you look at the right-hand graph, now that one takes the rand real effective exchange rate against our trading partners. So that's a weighted real rand exchange rate. Now there we can see that it's actually trading very close or at the zero line, still slightly undervalued, but very much at par. Now, if we think in terms of our euro rand rate trading well below the 17 levels, we look at a pound level, sometimes slightly above the 20, sometimes below the 20, but on average, our value of our currency based against our trading counterparts. Now, trading counterparts weighted in terms of what we do in trade against Euro, China, etc., and the United States, then we can see that the rand is not that much overvalued or undervalued. So this clearly tells us, if we go back to the value of the dollar and we go and look at that high value of the dollar index, that this and what happens in the world is actually a story of the dollar and not so much of any of the other currencies. And hence why I sort of focused a little bit on what do we think in the back end can happen to the dollar as their figures deteriorate in terms of their economy and what happens there and the value of the dollar on that. Our terms of trade are now neutral. It was very positive. Now, when the oil price was extremely low, especially going back to 2020, when the oil price was in the low 30s and 40s, we, as a big importer of oil, that's our biggest import into South Africa, is our oil. We had spent a lot less on oil. Now we're spending a lot more on oil. I also think with commodity prices, that's already taken a dip. That the money that we earn from our commodity side a little bit lower, oil spend much higher, but also in other parts of our export markets. I'm even thinking in terms of the agricultural side, we earn a little bit less, which means that our trade of terms that was very, very positive is now neutral. But if you look at the right-hand graph and you look at our currency performance, then the rand's still not doing really that badly. We saw sort of in the middle of the pack, lost some 6.13%, but not in our own right doing that badly at this point in time. Commodity prices remain one of the big supporters of the currency, and with the decline that we've already seen there, one's got to look forward and think what will happen in terms of commodity prices going forward. Now, I think with the decline that we've already seen in commodity prices, figures already coming through for weaker economic growth throughout the world. We look at what happens in terms of the production. That's a problem in South Africa, that our production of commodities is a lot lower than it was. But not only is that a problem, the actual transport of our mined products through our harbors also very slowly. Clearly a problem of Transnet, but we know that there's a lot of money being spent in the on the port side in Maputo, so some of the commodity prices, some of the commodities finding their way through the ports of Maputo. So I think the worst is most probably over for commodity prices declining. It will flatten out, so it remains still a support level for the rand. Electricity is still a problem in South Africa. We don't have to go into that too much. First of all, the cost of electricity, because of the debt situation. We expect some announcements by the Minister of Finance, if he's still in the office by then, during the medium-term budget speech, as to what happens with the debt of Eskom and how sustainable that will become, or whether some of that will be taken up or over by the South African government, and how that will change the outlook for Eskom. We know that major announcements has been made in terms of IPPs, but electricity still a problem in terms of what happens in our economy and the effect of that on production throughout the production sector. Trade surplus, we spoke about, that's still surplus. Trade terms neutral, but our trade surplus is still intact. It's narrowing and looking slightly worse than what it was at the height of it, but it's still positive, so still not really anything to be too concerned about at this point in time. So if we look at all of this, then at the back end of this year, with a dollar that could lose some of its shine, it's my opinion that we will most probably see the rand improving a little bit. We need to get through the end of August, beginning of September. Traditionally, for the last 10, 15 years, August has been not the best of months for the currency. But we also this year had the problem in terms of a euro that once again broke below the parity level, but towards the back end of the year and from the middle of September onwards, I think we will see the rand doing better. We will see a euro doing a little bit better because of a dollar losing some of its shine, and would not be too surprised to see a rand trading back down to a trading range of between 16.10 and 16.50 towards the back end of the year. I tried in going through it not too long so that we have more time for questions. So time for questions, over to Andre and myself, and we're happy to facilitate some questions.
Yeah, thanks, Andre, for the update. I want to kick off, Andre Botha. There's been a question about what is the horizon that's being used to address inflation of interest rates? And what's the lag period before the effect is seen on interest rate, inflation, interest rates?
Okay, thank you, Bichal. Thank you for the question. First off, the problem with monetary policy is that we are using yesterday's data with the fix for today. And if on the easiest term of this would probably be, if you look, America started hiking interest rates 3-4 months ago, and in the last CPI number, we saw a little bit of a dip in inflation. So the easy question is to say 3 to 6 months. But then again, there are many ships in this little monetary policy sea, where you see the first ship is inflation. That's quite easy to turn around, if I put it in layman's term, just because it can be produced or consumers adapting their spending patterns, and the cure for high prices is high prices in a way. And that could be, inflation could be the first one. The next few ships are a little bit bigger, and that is economic growth, and all interest rates and all those sort of things. And if we look a bit further, the impact of hiking interest rates could be a little bit longer in economic growth. So for the inflation part of the question, I would say 3 to 6 months, but there will be repercussions as the bigger ships are turned around in the future. So I think the first effect on economic growth, especially in the US, will probably be seen later this year, but that will be a recurring theme going into next year.
Thanks, Andre. Then nextly is the views on monetary policy, followed by Turkey kept on lowering interest rates while inflation is extremely high. They like outlier again, same as China.
Yeah, that's a very interesting one in terms of Turkey. We just saw President Erdogan. I see Andre Salia smiling there. President Erdogan came out yesterday saying that not all economic analysis is equal. It's not set in stone like math or physics, but I think some things are sort of set in stone in economics. He said they want to produce product. They want to. How can I say it? Increase productivity, current account surpluses, and so on and so forth. And they won't hike interest rates in the months going forward. The problem I have with that is that, yes, in a way, productivity fights inflation. The more you produce, the lower you can bring your costs. But that is in the backdrop of a world economy that is struggling. So I think he's barking up the wrong tree. At some stage, there will be or there's already a massive fall on Turkey, but I think the snowball is only starting at the moment.
Andre, do you want to continue and give some comments on that as well?
I'm just going to say I'd be very concerned if Mr. Ramaphosa starts managing our monetary policy in our country. And I'd be very concerned because that loses the complete independence of a central bank. And that's exactly what happens in Turkey. We can almost discard the president of the central bank of Turkey because he's just a puppet in the whole situation. The president of Turkey is actually managing their monetary policy. Very, very dangerous, definitely not sustainable long term.
100%. There's a question about the forecast interest rates for South Africa for the rest of the year, but I think we've tackled it. Like I say, I'll just reiterate it. We think interest rates are probably going to rise by another 75 basis points to probably 100 basis points in the coming 6 months before we will probably see it topping out and leveling out. And then perhaps down 2024, we'll probably look, depending on our growth and data dependent, the numbers are at rate cuts again. Then there's two questions we have here. One is about which asset class is best currently to invest in, and is it safe to invest in property in South Africa? So unfortunately from our side is we're not in that space about which asset classes we allow to invest in and property. That's not part of our FSB license that we operate under. We're just a services company where we render services on behalf of clients. So unfortunately it will be difficult for me to answer that question to you. It will be rather better to seek asset managers like the PSGs and those of the world to answer those questions. Then there's a question about which global...
I will just quickly come in. The only thing that I will answer to those questions is there's a fantastic word used in the markets. It's called diversification. Now, diversification is the fancy word. The older generation simply spoke about not having all your eggs in one basket. Go speak to your asset managers and diversify is the answer there.
Then there's a question about which global macro factors will lead us to conclude that rates will top out soon. I'm not sure which one of you want to tackle the question.
I'll take my first part. I think the first macro factor will be growth. I don't know. I've read somewhere that Jerome Powell wants to be the next Paul Volcker and hike America into a recession. But I think just in terms of the way the global economy is at the moment, the more we hike ourselves into a recession. So I think growth is probably the main one to look at in terms of the global macro factors. I don't know what you are, Andre.
I agree 100%. And as economic figures, and I've briefly mentioned that during the presentation, as the economic figures throughout the world turns negative and highlights the negative impact of the increase in interest rates and the slowdown in their economies, it will return the focus of the central banks to come back into the markets, relook at what they're doing, and start moving their economies out of recession. And the way to do that would be to start lowering interest rates again. And I would not be too surprised to see a change in that already towards the middle of next year, going into the third quarter. So the economic data coming out will change that for us as we go forward.
Then one of the other questions is if energy is the main contributor for inflation, how does that affect the pricing?
The pricing of Meshach, I'm not quite sure if energy is the main contributor of inflation. How does that affect the pricing? The pricing of what? I'm not quite sure what he means by that question.
100%. Then one of the other questions surrounding China again. Obviously, there's, like we know, in China there's droughts, in the Eurozone there's droughts, the Rhine River is its lowest levels ever. It's similar that's happening in China. So the question is, is the problems in the drought and the heat wave and inflation in China a global threat for the world economy?
I don't think that the impact would be that disastrous. It will definitely have an impact, but it might even benefit some other countries in terms of their exports of certain products into those areas. So whether it will have a dramatic impact on world economic growth, I doubt that will be the case. But as I say, in terms of their own economies, might be negative, but that simply benefits other countries that could export certain of the products, but not that much of a negative impact overall on the world growth. Andre, what do you think?
The only thing that can come to mind is the same thing we had in the last couple of months or last year or so, is supply chain issues, and that's just with production being down in China. But as you correctly said, that just opens the scope for other countries. And we had a big discussion about this the other day regarding, is this sort of the end of globalization in a way? And what I mean that is, will countries become sort of more independent rather than rely on China? And as you correctly said, if we go to that route where countries rely on themselves a bit more, then this won't have a massive impact, according to me. Just what you said.
And there's a question about the Russian ruble strength, which I also might tackle. So the thing is about the Russian ruble, why the Russian ruble has done really well this year, is because of the sanctions that were imposed by the developed country across the world. And President Vladimir Putin just said, we'll still give you energy, but we're not going to take payment in US dollars like we used to. we want to take it in the Russian ruble. So there was a massive scramble to get rubles. The dollar is the most liquid currency in the world, and there's plenty of the dollar to go around. If you look at the Russian ruble, it's not the case. So there's a massive scramble. So everybody was selling all the other currencies, their dollars, their euros, the Japanese yen, the South African rands, and buying the ruble. On the other side is there's not a lot of imports from Russia from other countries. So they're not importing. If you look at Starbucks, the McDonald's, all the big corporates in the world is pulled out of Russia. So all those products used to be imported that was paid. They used to convert the rubles into other currencies. That hasn't happened. So it's a two-way factor. It's the demand for rubles, because Vladimir Putin only wants to be paid in rubles, and then the lack of imports out of Russia. So they've heavily got a big surplus at the moment because they're exporting a lot of energy, but they're not importing a lot of products, and that's the reason for the ruble strength. Andre, we're gonna just take another one or two questions. Does South Africa have the ability to bootstrap itself, especially considering growth as the key factor to address the current situation, given our issues with Eskom, defaulting municipalities, and poor policy by the government to support the independent and private sector?
Okay. South Africa is a very, very resilient country. And there's something positive that comes out of the defaulting municipalities and Eskoms and etc. And if we look at the decisions made by the government, by the ANC, and the announcements, for instance, on IPPs, and we look at the impact of what happens at Transnet in terms of railway lines, etc., a lot of that is very positive that they're doing, and the announcements that they make. But apart from that, from the defaulting side, we see a lot more dependence on the private sector, and the private sector comes to the rescue of this and is actually supporting possible privatization. So being a very resilient country, I think, yes, we do have the ability to come out of this on top of and even be better going forward.
So then I was going back to Meshach's question about inflation and the pricing. So the question is about pricing of energy such as oil, petroleum, gas, as well as coal plant spares and stuff. If energy is the main contributor to inflation. Okay.
Well, yes. If we see further increases and we see further hiccups on that side in the pricing of energy, then it will have further negative effects on inflation. I do, however, think that, and I've said it, I think, in the previous presentation, that if you look at what happens throughout the world, we'll still be fighting in the Ukraine a year from now. We're going to learn to live with it. Markets will learn to live with it. And I do not think that we're heading for $140 or $130 per barrel on oil, for instance, again. So I do think that this problem will sort it out and will stabilize and have some stabilization in terms of pricing. So I think the worst is actually behind us.
Okay, then lastly, Andre, I'm going to throw the last question to you before we need to just wrap it up. The question is, do you think potential conflict, should it happen between China and Taiwan, will influence the South African trade balance and therefore the rand? And then onto that as well is, do we see demand coming from stimulated growth reference in response to macro factors in question? Is the current stimulus debt relief about US student loans that suggested, is that sustainable?
Which Andre are you referring to?
Yeah, sorry.
Yeah, the potential conflict in China, Taiwan, I think it will probably, if it happens, I can imagine that the initial response to it won't be very good for emerging market currencies like the rand. But I think that a China-Taiwan conflict will be a lot more global than just so you have to look at every other trade balance, and I think trade will definitely be affected. So just in the short term, I think if something like that will happen, it will be bad for the rand, and we probably see the rand edging a bit weaker.
Then secondly is about just
then
the
the second-
sustainability of debt relief programs in the US that they're proposing about student loans again now.
Where I see demand coming from, well, just hiking the interest rates and the inflation at the moment is the thing that will drive up demand. So just back to Andre Silier's comment of starting to lower interest rates, I think demand will start picking up from them lowering interest rates and having more disposable income to start getting that demand. I think the debt relief will be good in the short term, but yeah, as I said, it all depends on if there's a soft landing or not, how the economy goes. If there's a soft landing, then there's a potential for demand to pick up. But I mean, as I said earlier on, the biggest ship is the economic growth, and if economic growth struggles, then there's going to need to be a lot more relief packages and everything to get the ship turned around. So for the moment, I think they'll probably go with interest rates first to see whether that will pick up demand. If that doesn't happen, then I think there will be some few more relief packages coming.
There's just one last question. I'm not sure we'll be able to answer this because I'm not sure that it's made up. But there's a question about is why does diesel prices rise more than petrol prices and then decrease less than petrol? It's probably about how the makeup is about the imports and how the product mix is, but I don't know exactly what the product mix is. I don't know if everybody wants to weigh in on it.
I have not got too much information on that, but there's two factors. It's the product mix, and one of the biggest things there is the refinery process is completely different from fuel.
Yeah. So
Thank you so much.
Finance Ghost, it's over to you.
Was there?
There was one Finance Ghost question. Yes, there was. Somebody had asked the question whether we think equities has hit bottom.
Yeah, there we
and
go.
whether
That
it's
question
about to turn.
always
That's
comes
for
up.
you,
Look,
Mr.
I'm not a
Finance
short-term
Ghost.
trader, so I think the technicals are always a risky game to play, and I mean that's a sort of art form unto itself. Fundamentally, the US has had a pretty good run. I mean, we recently recapped Disney in Magic Markets Premium this week, delved into the numbers. That then ran all the way back up to what we think is fair value. There's other examples of companies where they've bounced pretty hard. So I still think it smells a little bit like a bear market rally. If I look through some of those earnings overseas, I think they're still dealing with lots of challenges, and I think the market might have got a little bit ahead of itself. In South Africa, it's the old story. Investing long-term in a lot of our companies is tricky because they are ultimately operating in a relatively low-growth economy. So I think the JSE is a nice place for shorter-term dislocations, maybe medium-term positions. And if you're looking for sort of stuff you can buy and just forget about in your drawer, there are a few of those on the JSE, but I personally think that some of the more global options are not a bad place to look for that kind of stuff. I think Disney is going to still be there for a very long time, for example. So guys, I just want to thank the TreasuryONE team very much. Just, for everyone's benefit, they are a really important brand partner to GhostMail. They are a big part of why you get GhostMail for free every morning. So thank you to the team from TreasuryONE. I would recommend go and check out the TreasuryONE website. You'll find it at treasuryone.co.za. You spell out the one, it's not the number. Go follow them on Twitter. It's at TreasuryONE. Again, spelled out, it's not the number. And just thank you so much for all the insights every morning in GhostMail, for doing these webinars for our audience. And thank you. We'll do another one of these, I hope, in a few weeks' time.
Yeah, thank you so much for hosting us, giving us the platform to talk. Enjoy your day. Everybody, thanks for joining and enjoy your day.
Okay, thank you.
Thank you.